Welcome to Venetia. Today, we focus on a fundamental rule in trade finance, the ICC UCP 600, specifically Article 37. This article governs bank liability when multiple banks are involved in a letter of credit transaction.
I'm your host, and I welcome all beginners who are new to this complex but essential area of global trade. We will move slowly, explaining every concept clearly. When an issuing bank uses another bank in a letter of credit transaction, who is responsible if the second bank makes a mistake or fails to carry out its duties? This is a core question in trade finance. For those of you involved in import or export, understanding bank liability is crucial for managing risk. This video will explain exactly where liability rests according to the UCP 600. This video breaks down Article 37 into 4 clear sections: A, B, C, and D. By the end, you will understand the bank's limitations on responsibility and the applicant's indemnity obligations in trade finance. We start with a quick overview of letters of credit, then define UCP 600. Next, we will cover Article 37, section by section: risk to the applicant, lack of liability for failed instructions, responsibility for bank charges, and indemnity for foreign laws. A letter of credit, or LC, is a promise from a bank, the issuing bank, to pay a seller, the beneficiary, a specific amount of money, provided the seller presents the required documents on time. It is a critical tool for minimizing payment risk in international trade. The UCP 600 is the Uniform Customs and Practice for Documentary Credits. These are a set of international rules published by the International Chamber of Commerce, or ICC. They standardize the rules for issuing and handling letters of credit globally. Article 37, titled Disclaimer for Acts of an Instructed Party, establishes that banks involved in LCs limit their responsibility. Specifically, when an issuing bank instructs another bank to act on its behalf, the issuing bank is not automatically liable for the instructed bank's errors. Now, let's look at Sub-Article 37A, which states, a bank utilizing the services of another bank for the purpose of giving effect to the instructions of the applicant does so for the account and at the risk of the applicant. An instructed party is any bank, other than the issuing bank, that receives instructions to perform services related to the letter of credit. This is often the advising bank or a nominated bank authorized to pay or negotiate. The core meaning of 37A is this: when a bank, following the applicant's request, uses another bank, any consequences, losses, or errors caused by that second bank are the applicant's responsibility. The applicant assumes the risk. Imagine the issuing bank instructs an advising bank, but the advising bank delays in advising the credit, causing the beneficiary to miss the shipment deadline. According to 37A, any resulting financial loss or dispute is ultimately borne by the applicant, not the issuing bank. Now that we have a grasp on the applicant bearing the risk of using a second bank, let's see how this relates to the bank's liability for failed instructions in 37B. Sub-Article 37B clarifies that an issuing or advising bank has no liability or responsibility if the instructions it transmits to another bank are not carried out, even if the instructing bank chose the other bank. The responsibility ends when the instructions are transmitted correctly. Think of it this way: you hire a general contractor. The general contractor hires a specialized subcontractor. If the general contractor provided the correct instructions to the subcontractor, the general contractor is typically not liable if the subcontractor fails to perform the work, assuming they were chosen with reasonable care. This leads us directly to our next key idea: charges and fees, covered in Article 37C. This section addresses the financial obligations of the banks themselves. In the context of UCP 600, charges refer to commissions, fees, costs, or expenses incurred by the instructed bank in connection with carrying out the instructions. These are the costs associated with the service provided by the second bank. The rule is clear: the bank giving the instructions is liable for these charges.
Crucially, if the LC states these charges are for the beneficiary's account and the charges cannot be collected from the beneficiary, the issuing bank remains ultimately responsible for paying them.
Furthermore, a credit or amendment must not stipulate that advising the beneficiary is conditional upon the advising bank first receiving its charges. The advising bank cannot hold the LC hostage until it is paid. Finally, we address Article 37D, Indemnity for Foreign Laws. This section deals with the legal risks that extend beyond the bank's own jurisdiction. Sub-Article 37D mandates that the applicant shall be bound by and liable to indemnify a bank against all obligations and responsibilities imposed by foreign laws and usages. Indemnify means to protect the bank from loss. If a bank, while processing an LC, faces unexpected fines or legal liabilities imposed by the laws of the beneficiary's country, the applicant must compensate the bank for those losses. This shifts the foreign legal compliance risk entirely onto the applicant. We have now covered all 4 parts of UCP 600 Article 37. This article fundamentally outlines the limited role of banks in the liability chain, placing much of the ultimate risk on the applicant. To recap, Article 37 covers the applicant bearing the risk of instructed banks, the instructing bank having no liability if instructions fail, the issuing bank's final liability for charges, and the applicant's obligation to indemnify the bank against foreign laws. Understanding these disclaimers is essential for anyone using letters of credit. It enables the applicant to properly assess their exposure and implement better risk management strategies in international trade. Thank you for watching this detailed breakdown. If you found this information valuable, please like this video and subscribe to Vanija for more content on trade finance. Leave your questions or comments below. See you next time.